Hey, good morning. This is Julie, J Auto Trading Strategies. It's Monday, December 14th. Take a quick look at what's going on with the markets. Oil and gas are continuing a tumble, $35 a barrel. Can't believe it. And it's like no end in sight. That's why I've decided to go to a different market to get better trading opportunities for directional moves that are a little bit more steady. I like to say I cut my teeth trading crude, but as every infant grows and picks up their legs and starts walking, I need to walk away from crude and get into a market that trades a little bit better and more dependable and less erratic. And crude will be anything but less erratic as it bottoms out over that OPEC ceiling disappearing and the globe, everyone globally trying to get away from fossil fuels. The climate has been horrible. I agree. If fossil fuels has been causing this weather, then we definitely need to find some alternative energy sources. So if that all happens, we need to be looking at replacing crude in our portfolios. High yield woes. We've had debt markets freezing up a little bit last week. However, I would not say that the bottom is in or even close to it. I mean, the Fed, once it starts raising rates, it's going to be doing it in barely, I mean, hardly anything, and slowly. So at first blush, I would think that that rate hike would be a positive impetus for the markets, but with the Chinese data still plunging and Europe still in a recession, it's just going to be hard to say how to trade this rate hike. Bloomberg, my favorite content for market analytics. Their charts, their articles, and their people are just awesome, and I especially like that Stephanie Rule. She is just incredibly smart and a fantastic analyst. So here is the yield curve flattening on the Treasury from past federal rate hikes. Past history, the past 4 decades, the Federal Reserve raised rates to stem inflation and keep economic growth from overheating. That's not what we have today. We have zero inflation, and with no end in sight on that with the oil. And our economic growth has not been overheating. It's been artificially engineered. So anything but these past yield curves tightening, I would say go against that trend, because expect the unexpected is what I'm trying to say. I would not think that this would be the status quo on this hike. So where are we in the markets? Let me pull up my daily chart so that you can see where we are. I'm expecting a return to this gap line. We first created a gap line, went underneath it, and then rolled over it a bunch of times, and then gapped up and over it. So on this first bounce, I would expect to come down to the gap line and then bounce hard. And this would line up with the stochastics and perhaps that momentum inflection at the zero line. I keep my eye on these divergences because that is the best tell on which way a market is going to go. And if you can buy into a divergence or sell into a divergence, that is what you want to do. But for right now, it's the gap line, and price is moving down there towards that line. So we'll probably get a bounce around that area, I would think, around Wednesday. So it looks like we're coming back into this lower area. And how does that look on the lower time frame? Here we go. We have our Globex, and overnight we have pushed through the Globex low, and the river of gold is sitting on top of us, so we're definitely short. This also, let me get this out of here, sits well with my direction guide strategy. We've got weekly, daily, 60, 15 all in the red, so we know we're going short. We're below our river of gold, so we should be looking primarily for shorts. Right now we've got that divergence coming up back into the mean. So here's our VWAP at 25, 2005, and here's our point of control for our river of gold at the value area high. So this looks like it's a very good target between 2011 and 2015 to trade to for a reversal area to come back down short. But right now we've still got our flat tops on our Heiken Ashies. So I have not given up on this downtrend yet, although it is looking long in the tooth going into our open with this divergence. And this is short-term divergence. This is a 30-minute chart. And this is just your reversal to the mean trade. So either you take that divergence and start hitting these bottoms for your counter trend, or you just sit it out and wait for price to get back to the top of value and take your trade up here back down. So you can trade both ways. If you are counter trend trading, be careful. We are in a 30-minute slope down frame. We still have the top of the candles, but I do think that we're going to start seeing some wicks here as we punch up and down through this value area back into the value. So short-term trade until we can get to the top of that value and then bring it on back down is my game plan. That's my trade plan for today. And follow the direction guide for the overall favored bias of the market. And make your money. It's like mining for gold. It's the last of the Wild West opportunities, the super frontier, and you can do it too. If you like any of my templates, just let me know. I'll be glad to get you set up so that you can start watching the markets with a systematic template and trade plan. Thank you so much.